All right, guys, welcome. Happy Friday. Welcome back to another episode of Fintech Fridays. I am really excited to have Jeff Keltner on from Upstart. So we normally, I shouldn't say normally because this is not going to be an abnormal podcast. So we a lot of times have folks on from inside the mortgage industry specifically. And I've been following Jeff on LinkedIn and just really a fan of the content. And I thought, what a great way to learn about Upstart and kind of what you all are doing by having you join my podcast. So thanks for joining.
I'm happy to be here. Thanks for having me, Brian.
So I don't know that you know the protocol, but I warned you ahead of time. I like to open these episodes by asking my guest to share what the term fintech means to you in the context of your business or even consumer life.
Okay, we'll say employment to start with. It's my employment. I like that. It's a strange term. I feel like it means different things to different people and has undergone a number of evolutions. I think there are versions of fintech that are really, bankers who hire slightly better developers that want to make something that looks a little less, old school than much banking software. But I really think of a lot of the newer fintechs, and I put Upstart in that category, obviously, as really bringing the ethos and the modern technology capabilities and saying, how do we really rethink old industries, in this case, the finance industry. But I think that takes a lot of flavors, whether it's people who look like banks, who are direct lenders, people who are, being more traditional technology partners to lending institutions the way Upstart does. It's a pretty broad range.
Yeah, I agree. I think for me, I've been, in this, I'll say, fintech space for about 2.5 years. And I came out of mortgage, right? I came out of the mortgage industry, and I'm now amazed at how many mortgage lenders call themselves fintech when they're not doing anything different today than they were doing 10 years ago. But
yeah, I mean, and we come up from the opposite side. I came to Upstart from Google, along with a lot of our founding team. So we're really tech people who came into finance. And I do think I've heard it called tech fin or fintech, and like whether you're really at the core a technology company that happens to be applying technology to financial services, or whether you're really a financial services company that's trying to have slightly better technology. There are just different DNAs, different leadership teams, different approaches to development. And I think there's a lot of both, but they're very different animals in the end.
Love it. Well, thanks for sharing that. Well, let's dig in.
Sure.
Let's start by helping our audience here understand who is Upstart and what do you guys do?
Yeah, so we're not a mortgage or real estate related company. So I will start with that. So Upstart's a AI-powered digital lending platform, and that's a mouthful of buzzwords. But at the core, we provide a set of technologies to banks and credit unions to allow them to offer a kind of seamless origination process and more sophisticated underwriting capability for today personal unsecured loans and auto refi loans. And we're kind of working with our partners and looking at other kinds of assets. So kind of maybe the far end with personal loans from what a mortgage is, the unsecured loan. But really, I think that forced us to focus on the tech part of fintech, right? Which is these are loans that you can think of these loans as an average of $10,000 or so, an average of 3 or 5 year duration. So shorter, smaller dollar. But that really means the customer's patience for process is much, much smaller, right?
Yeah.
So, we work for about 70% of the loans on our platform, maybe 75 now, have no human intervention, not just underwriting, but income verification, ID verification, all done through automated means. And that's something that in that unsecured space you have to do because the cost is too high to bring them into a branch or talk to them on the phone. So we really started there, but we think the same thing is true across other assets. People want that same kind of seamless experience. And so we're always looking at how do we apply those technologies to other kinds of things. But so that's at the core, we operate in that space and we power the product for our bank and credit union partners, a little over 24 of those partners today.
Nice. So similar to FinLocker, you're not going to find Upstart from a consumer perspective, but you may be engaging with Upstart through, a bank or credit union. Is that fair to say?
It's both for us. So we've got I brushed over a little nuance, so we'll dive into it, which is the things we help our partners with, the kind of software to originate loans, for sure. We service the loans for some of our partners that just don't have the capability, the expertise around that particular kind of loan. We've also found that a lot of our financial institution partners, particularly now Brian, where they're sitting on more deposits than they're used to. Maybe demand for traditional types of loans that have usually filled their balance sheets is lower due to the pandemic. And so we also have a pretty at-scale marketing program for consumers, and then we will match each consumer with one of the lenders in our network based on the offer we can get them. So we don't ever originate. We don't really hold on our balance sheet. We're not that kind of lender or that kind of a company, but we do some consumer marketing pretty at scale that helps our financial institution partners make sure they have enough demand. What happened here is I want to put X million on my balance sheet, and then I don't have demand for X million, but I want the diversification from an income source, from a balance sheet point of view. So we'll help them acquire those consumers through Upstart branded marketing programs. So you will run into us in that space as well.
Yeah, no, that's cool. And now that I think about it, I think 2 or 3 weeks ago is when I first started kind of seeing you on LinkedIn. And I think you had even a friend or some kind of mutual acquaintance on one of your podcasts. Is how I can't remember who it was now. But I've been paying attention, and it seems like, well, first of all, because I was paying attention on this thing's paying attention to what I pay attention to. Yeah, so all of a sudden,
they do that.
I'm seeing Upstart everywhere.
Yeah, we'll follow you around a little bit. And we are, we send out a couple million pieces of mail a month, and we're on some streaming TV services. So it's not impossible that you've run across us. But I'm glad the content is finding you on LinkedIn. And as you said, I do have a podcast that we do that's targeted at bankers. So we're speaking, a lot of our messaging is towards financial institutions who are really ultimately the partners, the lenders in our programs, and pretty critical to how we go to market.
Do you, this is more curiosity than anything, is there a certain segment of those community banks or credit unions that makes the most sense for you? Smaller, bigger, medium size, or?
I'd say we kind of started with the belief that, hey, we need to be in certain categories, and we found success across the spectrum. I will say when you get much under maybe $500 million in assets, just the effort to, and this is one of the things that I think about for fintechs, is a lot of financial institutions need to figure out how to partner with fintechs, and the muscle isn't that strong. And so the amount of effort that goes into getting a partnership over the line is non-trivial. And there you just got to go, hey, are we going to do enough business together for it to make sense for you to go through that effort, for me to go through that effort? And I think for the really small institutions, that's not true. But we've seen a pretty broad diversity of interest. And I'd say that the bigger qualifier versus size or kind of institutions, like how interested are you in really investing in consumer lending? Because you see in community banks that they want to have mortgages and commercial real estate, and they don't want to have more risky kind of assets. And then you find others that really do. I think credit unions are more common than banks to have a real interest in the consumer lending category, but that's really where we find a bank or a credit union that has that interest. That's what really probably tees them up to be a good partner with us.
So I know you've thrown around this term consumer and customer a couple times already as we've been talking. And then this morning, I saw some of your content, and you were talking about what makes a consumer a customer. Yeah. And I thought that was a very interesting question, and I'd love to just kind of pick at that a little bit.
Well, I've got to be careful because I just finished my compliance training, and there's like legal definitions for both consumer and customer that's interacted with your institution. But, when I talk to financial institutions, what I typically hear is, that a customer is someone who's got their primary checking account with me. That's a customer, right? And you see so many incentive programs, often misguided, I think, trying to achieve that relationship. Like you get a mortgage, it's like, well, we'll give you 25 bips off if you have a checking account. So you're like, okay. And you open the account, you put the required $50 in, you probably pull it out a month later, and you don't really move your account. But I think it stems from this belief that having a checking account equals having a more deep relationship. And I think my perspective is that's not really true anymore. But that having that bank account, it does give you unprecedented insight into that customer's needs, their creditworthiness, right? So you should be able to serve them more effectively. But I think the idea that because you have my checking account, you will get my next product is not true, right? And I know, like I have loans with a number of institutions, right? And I'm looking for the best rate, easiest process. So, the thing I said, I don't know if I laid this out in my video this morning. I sometimes forget what I say. But I think you ultimately have to be able to deliver to a customer one of three things, ideally two or three of these things, in order to earn repeat business, right? To earn loyalty. And in my mind, those three things are, I got to be able to offer them a better rate than my competitors, right? And again, if you have access to their checking account information, you have much more visibility into their spending patterns, their debt. Like, you should understand their creditworthiness better, and therefore be able to offer most of those consumers better pricing than a bank credit union they never worked with. Secondly, to me, is can you offer a simpler experience, right? And this one gets really easy, right? Like, you shouldn't have to ask for their name and address, right? Because you already know. Right. You shouldn't have to ask where they want the money to go. You shouldn't have to ask to verify their income, for instance, because if their direct deposits are coming into your checking account, you should know all that. Now, whether or not financial institutions take advantage of that knowledge to provide a better experience, that I think is not as common as it should be. But to me, like, if you have the checking account, you should be able to make the process simpler because you know these things. Yeah. And then the third thing to me is, maybe this is a little bit of a bias because the personal loans are often credit card consolidation, like refinancing loans. And I think you just ought to be able to offer better advice, offer insight, and say, hey, Brian, you're paying too much on your car loan. You're paying too much on your mortgage. You've got a mortgage, but no HELOC. Let me help you with some liquidity options with the HELOC. You should be offering advice and proactively suggesting services that are valuable to the customer. And I think having that primary relationship gives you an advantage in offering those. But if you're not leveraging it to offer 1, 2, or 3 of those things, a better rate, a better process, better advice, then you're probably not going to have earned the right, despite having the checking account, to get whatever that next product is. So in my mind, that's to cross that bridge is really about, do they turn to me for my next product? And in my mind, you have to earn that by having more than my direct deposit. You got to leverage that direct deposit to make my experience for the next product better.
I love that. And there's in the mortgage space, not quite the same, because your mortgage is not necessarily a transactional financial instrument. It's kind of one and done, and then you're dropping your payments on it. But to your point around the value of data and information, there is no financial transaction that a consumer goes into where you give up more information in order to get that transaction, to get that mortgage, right?
That's right.
And it is amazing still how a consumer who's with an institution, and actually they're the servicer, and then they're going to refinance with that same institution, how often they're literally starting from scratch, where they're asking the basics. What's your name?
It happened to
all the stuff that's.
I mean, I had this exact experience, Brian, and it was quite amusing to me. I actually got a mortgage through not my primary bank, and my bank called me and said, "Hey, we think we can give you a better rate." Well, good for you. You're proactive, right? You got my 3.
Yeah.
And then I said, "Great." I said, "Hey, let me email you the application." Great. What's your name? What's your address? And I went, then we get to can you provide 3 months of bank statements? And I go, what? Yeah. You're the bank. So, they hit on one, but they didn't hit on the others. And I think that's, to your point, there's so much information that comes. I mean, the number of documents I was asked to provide for that was crazy. And then the other point I said, and then I kind of said, well, should I get a HELOC while I'm doing this? They're like, oh, I guess so. And I'm like, well, hey, you probably should have recommended it. And they sent me a form and it said, you know what it said right after I closed my mortgage? What's your name?
Yeah. Start again. Yeah.
I just provided everything you're going to want. Like, you should have just said, it's like a burger and fries. Would you like fries with that? Yeah. And then you don't hand me your credit card again for the fries. It just should have been easy. And so that's where I think there's a huge opportunity, because those institutions have that information. They have those documents. They could have easily gotten me a personal line of credit, a home equity line of credit, right? And then I would have been leveraging those products. And instead I went, if I'm going to have to start from scratch, let me go check what I can get from somewhere else. Because why would I stick to just you guys if it's going to be just as hard as somebody who doesn't know me? And I think that's the thing is, if you don't move to that second stage of how am I leveraging the information I have to improve my customer's experience, then you haven't earned my loyalty, right? It has to be earned by providing value, and you haven't done that.
No, it's so true. And the downstream impact of whoever that institution was is that you're likely not going to recommend any of your friends or family to go to them.
No. No. And when I got to figure out where I want to open up an investment account, they're not, I wouldn't scratch them off the list, but they're on the list next to a bunch of other people when I go to Google and say, or go to Credit Karma, or go to a Wealthfront or a Betterment does great consumer advertising, and maybe my investment retirement account ends up there. And I think there's such value in having that holistic view for the consumer too, to have a single place to go. But in today's experience, like, I don't know how many apps I have on my phone, but it's not a small number. And adding one more,
Right.
Why don't you want one app? Well, I mean, 2 phone apps to check my balance in 2 places, not that big of a deal, right? So the barrier to me to having multiple relationships is a lot smaller than it was when I had to walk into a branch to do something. I went 15 miles away, and I don't know those people. Now it's pretty low. So that's an asset, but you've got to be leveraging it. And I think people are, if you don't, then it's not like you lose the business, but you don't get you don't necessarily get it either. Right.
Right.
And people are very willing to go look and check rates. I mean, the mortgage industry knows this better than most, with LendingTree's been out there forever. And like, just because I'm your bank, I'm still going, what's the competitive environment? Where can I get a better deal? And most of us are willing to take the pain of another app or another relationship today to get that better product or better experience if it's available somewhere else.
Yeah, I mean, we see that in the mortgage space specifically. There was a study by Black Knight that talked about customer retention, specifically in mortgage, and it's sub 20%. So only 1 in 5 of the customers that I would have written a loan for last year or 2 years ago came back to me if they were interested in a refinance. Less than 1 in 5. It's crazy.
Interesting. Well, and I think it's a very interesting point you make, because we're in the refinance game a little bit, not mortgages, but credit cards. And some of the financial institutions that offer credit cards are nervous about offering a refi product, because they're like, I'm the one being refinanced. Do I want to do that? Yeah. And of course, my ultimate answer is like, if you don't, someone will. Like, if that consumer has earned a better rate through whatever reasons, either their credit score's gotten better, they've gotten a promotion or raise, they've got a lower debt to income ratio, and their income's higher. You, as a financial institution with a relationship, might know that. If you've got the checking account, you might see an increase in the direct deposit and go, hey, Brian got a raise. And if you don't take advantage of that to offer a better rate to Brian, like, somebody else probably will. I think it's a really interesting part where most institutions are nervous about refinancing their own portfolio. And yet the reality is you're not only losing that loan in some instances, but you're losing relationship, because refinance is an amazingly strong product from a customer trust point of view. Like, when I call you and go, hey, Brian, you're paying too much, and I'm going to reduce your expense. I'm going to keep you in your house. I'm going to keep you in your car, but I'm going to cut your monthly payments. Like, I get a lot of trust and loyalty out of that product. And if you're the one being refinanced, you look like the one who was charging too much. So it's this interesting balance that I think is really in the refinance space. It's really curious. It doesn't shock me that you would see a lot of them coming out, because I imagine it's hard as the guy to go, yeah, Brian, you're paying me, X a month. Please pay me 10% less moving forward for the same loan I wrote 5 years ago. Like, do I want to do that? But the reality is, consumers can find that opportunity elsewhere, and they're looking. Yeah,
and you said it. If you aren't doing that as the servicer, then somebody else is, and the numbers show that. It's costly either way. There's an expense to having an asset run off, early, but if you're not replacing it with a like asset, or in the best case scenario, the same consumer, then it costs you a lot more to go get that new customer than it is to retain the customer you already have.
Easiest customer to serve is the one you already got. Everybody else is more expensive to acquire.
Well, I love it. We covered a ton of ground in a relatively short period of time, and it's what's cool is you're not in the mortgage space, but there's so many parallels to what people in the mortgage industry are dealing with, and how they're viewing the relationship with a customer, and how they're thinking about data and what you can do with that data to improve the customer experience, but also as an institution to potentially lower your cost to produce. So it's just fascinating to see kind of the parallels across the different parts of the financial industries.
Yeah, the industry is not that different. I mean, I think the big thing that I think puts the mortgage space in a different area that I would be very careful to watch how it could change, because it could be a step function change, is the GSEs, which I think because they dictate so much of policy and practice and data collection to complete the file. But if those policies change, like I said, at Upstart, our lenders for unsecured can do 75% loans with no manual documentation, just automated checks and back connections. And like, I know you can't do that in mortgages, at least not qualifying mortgages today, because like, you want to have a complete file from a GSE's point of view. But if those policies change, when we went, just this will be an interesting stat for your listeners. When for Upstart's lenders, when they can go from upload one document to this is a fully automated, no documentation loan, you between 2 and 3x your pull through, right? Yeah. That's the increase. Like that's a tremendous improvement in the business. And so, of course, then we went, hey, if that's true, let's go see how widely available we can make that experience without increasing risk. I think there's a lot of room there to improve the process on the mortgage side that's held back by policies that are, kind of imposed from the outside. But if those policies were to shift, the opportunity to make changes is going to be rapid and massive, because it's just a tremendously better experience for the consumer that translates into conversion rates, originations, the whole thing.
Yeah, I think you hit on this when you talked about your own experience in this refinance. If you had the ability to do everything in the app, let's say, or online, and didn't have to go get anything external, you're going to stay in that experience as long as the experience keeps you in the experience. Right. But as soon as it pushes you out to go do something else, that opens up the opportunity.
Like people don't come back. Probably a little bit less true in a mortgage, because like I still want to buy the house. More true in a refi, right? Where you go, well, I mean, how much was I really going to save? I was, like there's a friction there, and but it's when we saw the 2 to 3x, I mean that's a kind of a 10% improvement. It's like a 250%.
Yeah,
like that's
crazy
change. And so I think it just tells you how we always say this: the good borrowers are not just rate sensitive; they're effort sensitive. And it helps you realize how effort sensitive good customers can be, and how much benefit you can accrue if you can reduce the effort they're required to go through to get your products or use your products. And so I think that's a lesson we took away, and have really been applying that to every aspect of our business. How do we reduce the friction? Because sometimes it's just as valuable as reducing the risk, reducing the rate.
Sure.
It's more.
Well, this has been awesome, Jeff. Thanks for coming on, man. This is, I'm sure people are going to want to understand more about what Upstart's up to. We're going to, when we drop this and post this, we'll make sure to link to your all's, your website and your page on LinkedIn. If you're not following Jeff on LinkedIn, you need to follow him. He's got great content. Like I said, just maybe not directly in our space, in the mortgage space, but there's a lot of parallels there for sure. I appreciate you coming on, man.
I appreciate you having me, Brian. It's a fun conversation. Thank you.
All right. Well, thanks everyone for tuning in. We will see you next Friday for our next episode.